Hello everyone, today is the 20th of August 2026, and for once the main topic of my daily update is not gonna be crude oil, because there is something much more important to discuss at the moment. Yesterday, Treasury Secretary Bessent doubled down on the US long bond buyback program, a program designed to tackle surging US Treasury yields. Effectively, he just contradicted himself in a rather spectacular fashion, because when Janet Yellen launched this program, Scott Bessent was among its most prominent critics. The sudden announcement of the doubling of the US Treasury buyback program pushed long-end US Treasury yields sharply lower on Wednesday, and it also weakened the US dollar, taking the market and mainstream media by surprise. But not everyone was caught off guard. Coincidentally, several hours earlier, I posted a commentary for my premium subscribers on Slice. In it, I argued why US Treasury yields are more of a trap than an opportunity. What brought me to write that commentary was a request from subscribers and friends asking about investing in ETFs like the TLT. The expected yields will be kept at current level and pushed lower, a policy that is heavily supported by President Donald Trump. Because long-end yields are a benchmark for many things, especially home mortgages. High home mortgage rates do not support demand for the housing market, and that market is one of the main drivers of the US economic growth. Here is what I said about all of this. If US yields continue to go up, being long bonds or TLT is a very bad idea. You will eventually be compounding your losses, as the TLT chart shows. On the other side, new policies might strengthen the grip on long-term yields that could be kept down by what's effectively a yield curve control policy without the direct involvement of the Federal Reserve yet. While investing in US Treasuries nominally preserves your capital, the real value of your money is another story. In reality, your capital gets devalued significantly through monetary inflation. Today, I wrote another article I wasn't expecting to write so soon. It covers the short, medium, and long-term consequences of the latest Bessent move. The article is called "The Short-Lived Relief of Treasury Buybacks and the Unsustainable Path of Modern Central Banking." I made that article free for everyone to read on my Slice portal. Just follow the link I shared in the description of this video. While the immediate market reaction is similar to when Janet Yellen introduced the program, I expect that once the market adjusts and absorbs the move, yields will resume their current upward path. The reason why is very simple and rather grim. US government debt continues to increase and the deficit remains deep. This requires more and more debt to finance the deficit and interest payments. With a caveat though, because of the buyback program, the US government does not want to increase the supply of long-end bonds to decrease the upward pressure on their yield. As a result, it is front-loading a lot of debt financing into Treasury bills. These bills are more sensitive to the Federal Reserve's rate policies. While this move offers short-term relief, you can intuitively see the problem. In the long term, this makes the US government debt more and more unsustainable, increasing the frequency of refinancing needs in the market. There is already over $7 trillion of debt expiring in less than 1 year, exposing the US government to the risk of a liquidity shock. If demand for US Treasury bills versus cash suddenly drops, we have a crisis. Furthermore, this is a double-edged sword, as I explained in my article. The US is reducing the supply of long-end Treasury bonds, the risk-free rate asset in the market. This pushes insurers and pension funds to find alternative bonds because they continue to receive cash inflows month after month from money printing. They now have to reinvest that cash in alternative bonds in the market. The alternative right now is hyperscalers' debt. The reason why hyperscalers have been able to issue a ton of long-duration bonds recently, attracting overwhelming demand as a result of this shift. And what is the risk of all of this? Clearly, the risk is of inflating financial bubble even further. In this specific case, it is inflating the AI bubble from its already incredible level. Furthermore, other governments are not going to stand idle watching the US make moves for its own benefits. As the US dollar depreciates, other currencies appreciate as a consequence. This appreciation will eventually impact their domestic economies. A stronger currency hurts the ability of local companies to export. In the medium term, this policy has already been ineffective, as we saw when Janet Yellen launched it. Look at the Japanese yen, which resumed depreciating after short-term relief at that time. Endgame of these policies is already known to us. Rather than learning from mistakes, the US is following the same footsteps of countries like Argentina, Turkey, and Japan have already walked in the past. That is why assets like gold are a great hedge against fiat currency. If you want to know how things will look, just take a look at this chart. You see the value of gold against the Turkish lira, the yen, and the US dollar. This chart shows what happens when fiat currency implodes. It also tells us we are still quite far from that moment for Japan. Many people confuse the yen carry trade implosion with the currency implosion itself. The yen implosion will still require many years to unfold brutally. There is another important matter before I conclude today's podcast. This matter is the endorsement of policies to inflate public debt away. Public debt that in the US just crossed a staggering $40 trillion. Other governments will not just stand there and do nothing. They will not continue accumulating dollar reserves that will decrease in value through time. That is why China and others are decreasing their US Treasury reserves, favoring alternatives like gold instead. In my opinion, gold might become a settlement currency among central banks in the future. But many speculate that China or the BRICS countries might back a currency with gold. In reality, that would expose them to the same problem the US had in the 1970s. Backing a currency with hard assets requires it to be redeemable. To be redeemable, you drain your prized reserve asset over time. This creates a sharp devaluation pressure on your currency in the long term. This is the type of premium content I share constantly with my subscribers. I also share trade ideas, market analysis, and directly interact with my growing community in our group chats. If you are interested in subscribing to my Slice portal, you can find the link in the description of this video. That is all for today, my friends. If you want to support my YouTube channel, don't forget to like the video, subscribe, and turn on the notifications not to miss my future updates. Thanks a lot for supporting me on X and for reading my research on justdario.com as well, where I just published another important article on a prominent AI stock. Have a good day, everyone. Bye.